Let's delve into the details of the stories now, where each Ghanaian will be required to pay a little over 8,700 cedis when the country's debt of 263 billion cedis is shared among 30 million people in this country. Now, this comes after the nation's total public debt stock inched up by almost 7 billion cedis between June and July this year. Charles Nixon Yeboah examines the rising debt level and its potential challenges to the economy and came through with this report.
The total public debt stock represents about 68.3% of gross domestic product and is gradually nearing the dreaded 70% mark. Between January and July this year, the nation's debt has increased by about 43.5 billion cedis. This comes as a concern because of the slower fiscal consolidation process and the potential cost as a result of a depreciating cedi. Figures from the Bank of Ghana indicate that the external component is estimated at 138 billion cedis, approximately $24.3 billion. The challenge in servicing the external debt is repaying in US dollars at a time in which the cedi may have further depreciated against the American currency. Prior to COVID-19 pandemic, the World Bank and the International Monetary Fund had expressed worry about the nation's rising debt levels, warning it poses a threat to the fiscal economy going forward. Their argument was that the nation might struggle to repay both principal and interest costs if its increasing debt levels are not checked. This is as a result of the expected foreign exchange risks and the failure to close the fiscal gap. Few weeks ago, ratings agency Fitch had also warned that the nation's credit ratings might be downgraded because of expected slower fiscal consolidation process. A downgrade of the economy could trigger liquidation of investments by foreign portfolio investors and pressure on the local currency. There is a school of thought that it's easier to borrow or take a loan, but repayment is always a test case. The country is expected to spend about 24 billion cedis on interest payment alone this year. This is 4 billion cedis more than it spent last year. 70% of the nation's taxable revenue is used to service debt as well as pay wages and salaries.
Well, Charles Nixon joins me in the studio for more analysis on this particular development. Charles, welcome to the program. What does this mean?
Well, it's more or less a worry to the nation because if you look at the rising debt levels, it becomes a matter of a concern. Let's look at the statistics. If you look at the foreign debt component, it's about 138 billion cedis, which is equivalent to $24.3 billion. If you look at the domestic component, it's about 125 billion. But if you consider the spread from January to July, if you look at the quantum jump, about 48 billion cedis, that's quite significant. The challenge has to do with, are those funds borrowed going into capital projects, which you can track the performance in terms of key performance indicators. But if largely we are borrowing to spend on consumption, then that's a greater concern. So government claims they have elongated or have profiled the debt to cover a long-term repayment posture or position. But the question is, are we on course? Because clearly on the fiscal side, the revenue mobilization end, it's been very slow. COVID had impacted negatively on us, but growth looks promising. So how is the government going to reposition itself in terms of revenue mobilization? You also have to look at the way your spending is done. You know, spending is very key. You must spend on very important projects, and that is very paramount. So the challenge has to do with repaying. You know, when the cedi every time depreciates against the dollar, there is an increase in interest cost. This year alone, we are going to spend 26 billion cedis in servicing debt. And that is quite significant. If you look at wages and salaries, the taxable, income that is used to service debt and pay wages and salaries, virtually nothing is left. So we keep on borrowing, and as we are in an election year, we need to spend in order to ensure that the government is retaining power, and that has been a major concern.
Yeah, but
so,
you know, it's very interesting you make these points, because whenever we speak to the vice president and managers of the economy, they argue that it's not about borrowing, but what you use the money for is all that matters. This has been their argument all through these months. Do you think it's justified enough?
I would say it's quite debatable, in the sense that, you see, if you look at the developed world, if you look at the size of their economies, if you look at their reserves, they have huge reserves, they have huge size of their economy, so they can borrow more. In case of a disaster or an uncertainty, they can easily use those funds to service, what do you call it, the debt. But if you look at our economy, our reserves is almost equivalent to $10 billion. If you look at the size of the economy, it is not so huge. So we have to always find a mix in terms of the level of borrowings vis-a-vis our economy or gross domestic product. And that has been the challenge. We are hoping that the profiling of the debt indeed materializes. If it materializes, then we'll have a way, or we'll have some leeway in terms of the repayment, because instead of paying for 4 or 5 years, you have to pay for 10 or more years, and that is good for the economy.
Wait.
But the challenge is future generations might have to service these debts. So we are hoping that the authorities will craft a strategy so that we will not be able to see this kind of levels. Already the Bank of Ghana had issued a warning. Ratings agency Fitch had also issued a warning. In recent times, Standard & Poor's have downgraded Ghana from B to B minus, however, with a stable outlook. But when these news keep on soaring, it sends a bad signal to foreign investors. We have a huge foreign portfolio investment in Ghana. And when they start liquidating or disinvesting their investment, there will be pressure on the city.
Charles, we're so
and
grateful.
if there is pressure on the city, you would obviously see inflation going up. So that is the challenge.
Obviously, we're so grateful for this analysis. Charles Nixon-Yeboah is with the Business Desk, giving us some insight into Ghana's growing debt stock.